Thanks very much. It's great to be here. So I'm a partner at a law firm called Moores in Melbourne, where I've been for about the last year. Before that, I was at PwC, specialising in infrastructure projects. The firm advises a whole range of organisations, so disability services organisations, developers, and also individual families with children with a disability. So we kind of cover the full spectrum of advice work in relation to the disability sector. A bit of a personal story about how I got into this. It's obviously something I'm very passionate about. My younger son, Connor, had a brain injury at the age of 1. And so that kind of introduced me to the whole world of disability. And so then we went around, looking for a place to renovate, and we were worried about what was going to happen to him in the future. So it was a whole world that I was somewhat familiar with, but obviously it became a very personal story. Unfortunately, Connor passed away 2 years ago, which is why I decided to focus on this space with the advent of the NDIS. I also have 2 cousins with a disability. By chance, their father, my uncle, is a guy called Bruce Bonier-Haiti, who was one of the key drivers behind the NDIS and was the initial chairman. So, how do I... Yeah, is that all right? So what I'm going to talk about, so I act for a whole range of developers. So we obviously act for disability services organisations and how they need to structure their projects. They're focused pretty much on SDA, and then also in the private developer space. And there's a whole spectrum of developers out there. So we pretty much act for the full spectrum, and we also act for some of the families who are looking to invest in some of these projects. So I'll kind of go through what the funding sources are for some of those projects and the different models, and that's usually impacted a little bit by the nature of the funding source. And then we haven't done as much in this space, but I see a real issue in terms of non-SDA housing, and I think everyone's concerned about that. Obviously, the returns or yields on SDA housing are decent enough to encourage investors in that market. But for non-SDA, I think that's going to be a really long-term solution issue, and it's going to be difficult to find a solution, but it's going to involve a mix of innovative techniques to get there. Right. So I won't spend too much time on this. I mean, obviously you need debt or equity. Touching on what Dan talked about before, some of the infrastructure funds are involved in some of the more sophisticated projects, and obviously summer housing is probably at the apex of that, to give Dan credit. But you need to obtain funding from somewhere. And if you go to the next slide. Financial institutions have been cautious. The ones that are able to, the infrastructure funds know how to manage risk a little bit better, and like Dan said, they're used to working in regulated environments. I'm not sure how they're going to hold, how long they're going to hold onto those investments, to be honest, because what I've seen, I don't think it matters, but what I've seen with Macquarie and other groups is usually they'll do it for 5 years, get a risk premium and sell out. But at that point, super funds will probably come in anyway, so it probably doesn't matter too much. But the more sophisticated lenders are able to assess risk better than, I think, the debt lenders, the typical debt lenders like the banks. I think the banks have really been very cautious around lending, and touching on, again, what Dan said earlier, they will usually lend on a land valuation basis, not a cash flow basis. When this first came out, I thought the lenders would. I thought this would be like a project finance deal, like finance on a limited recourse basis, where they would securitise the cash flows from the SDA payments. But it hasn't really worked out that way, and hence, there's always going to be a bit of an equity shortfall that needs to be made up if you have if you're just going to banks to fund these projects. So in terms of the different development models. Just click to the next one. I think I've just probably covered, the various options where you go through, the larger funds that are funding, then, blended developer equity and debt. And sometimes that equity will be provided by families, and I'll talk about that model in a little bit. And then obviously you've got existing residents that have been transferred that currently live in group homes, and that's slowly being transferred over to the not-for-profit and private sector. Those funds that I talked about before, again, I won't spend too much time on this because I think Dan's pretty much covered it, but they're usually investing in greenfield new builds. And that's, the returns on that, I think, are best. But in terms of other funding mechanisms, it'll really depend on what the entity is, because not-for-profits usually you can't take equity in a not-for-profit, for example. So the funding mechanism will sometimes be a little bit different. So in terms of some of the models that we've seen and we've kind of encouraged, because we work with a lot of families with children with disabilities, is getting those families to basically provide as much equity as possible and co-develop projects. So it may only be for 3 or 4 people that are going to be living in the dwelling. So obviously you need to have sufficient equity to be able to do that. Touching on what I talked about before, you need to be able to make up that additional equity to cover the additional cost of the build. So you have to be in a fairly fortunate position. I think the upside of this model for families who can afford it is it increases supply. And anything that increases supply in the SDA space is going to be a good thing because it takes, obviously, demand off other sources. I think I've probably covered that. I'll talk about the structures on the next slide. So usually, when these are set up for developers, they're usually set up as a trust. And families and other sources of equity can usually take or hold units or shares in that trust and obviously get the cash the returns once it's developed. So under that structure, the trustee purchases a property and the SDA provider enters into the head lease. And the structure that we've worked up is, again, fairly similar to the model that Dan talked about before. It's more of an operating lease type model that we've employed. And that seems to be working quite well. So this kind of touches on what I was talking about before in terms of the family investment. It really depends on whether it's a group of families that have invested and the only people who are going to be living there are the children of the investors. So if they're living there, obviously, touching on security of tenure, which came up before, the only way you're going to get security of tenure is if you own the property, and that's why we've been working with families to do this. So under that arrangement, obviously the family will get priority over the accommodation. There's always a risk that they're not getting along, and somebody might move out. In that circumstance, there's a right of first refusal in the trust deed whereby the remaining families have the option of buying those units, and if they choose not to, then the unit holder who's going to be selling out will have to go to the open market to find another child who would like to move in there. I mean, it's always an option to find another source of equity. Anybody else who's got money, who's interested in making a return, can invest as well. So it doesn't necessarily have to be a family, but the key focus of this model was making sure that the parents had comfort that their children have tenure and weren't going to get kicked out. Now, obviously, if they're the owner, they've got a bit of control over that. The only other option I'd talk about is that last one. I think there's a typo. It says first offer for purchase. I'm working on a model at the moment for an SDA developer where they're funding it via just commercial investors who are looking to make a return. But they did want to create an option for families to buy in. So if they do buy in, they basically get an option or a guarantee. They do get a guaranteed apartment for as long as that person holds units in the trust. So that diagram there is a basic structure that I've been talking about. Obviously, the property will be held by the unit trust. You've got the trustee company. They enter into the head lease with the SDA provider. Obviously, there's the collaboration agreement between the SIL provider and the SDA provider, and then there's a sublease with the NDIS participants. What that sublease looks like will differ depending on which state you're developing the project in. So I think that slide there is simply just a summary of the various options that I was talking about. I have seen some of the social housing providers looking at co-equity investments. So there have been some social housing providers that have been exploring the idea of co-investing with families as well. So for the disability service providers, I do see some options here, because usually they've got, for them to develop a lot of these projects, because they do have land and they've usually got a history of cash flow. So they're pretty well placed to actually borrow, and to the extent they can utilise existing land, they should be able to still be in a pretty good position. And I know that some social equity investors have been looking at the disability housing providers, the disability service providers, to provide additional supply of housing for people with disabilities. In that arrangement, there still needs to be a split, obviously, between the SIL provider and the SDA provider, and you need to be really clear about making sure that that there are conflict of interest provisions that are dealt with really clearly in those agreements. So we've been working with a few disability service providers where we've been advising them to split up those structures, and they'll usually have a separate entity that delivers SDA, separate entity that delivers SIL, different people operating within those units or those companies, and that seems to be working fairly well. So in terms of individuals not eligible for SDA, like I said before, I think this is a more difficult journey. As we all know, only 6% are going to be eligible for SDA. There are some projects that have been developed on an innovative basis where there have been kind of interest-free loans provided. Like I talked about before, the disability service providers have a role to play here. I know that I've heard that some disability service providers are making enough of a return in terms of the delivery of support services to actually cover the cost of the development of housing. I don't know how that's possible, but if that's actually accurate, that's an option. I think some people are opposed to that because it's basically keeping your hook into the people that are living there, and then that kind of reduces control and choice of disability service providers. But I still think, to the extent they have existing land, that they might be able to make those projects work. The blended models, if you just go back, I haven't seen a lot of projects where you've got a mix of SDA apartments and then a mix of non-SDA apartments that are going to be done on a blended basis. I think all of yours are SDA, and that's to get that return of 6 to 9%. There's an opportunity to have a mix of where you'll get a lower return, of course, but it might only be 4 or 5%. But to the extent that you can cross-subsidise the non-SDA housing through the SDA payments, I see a lot of opportunity for that. I just don't see many projects out there where they're doing it. Most of my clients are either developing houses, which is all SDA, or they're developing usually complete apartment buildings with about 15 apartments or 16 apartments that are all SDA. So I haven't seen a lot of developers or even disability service providers out there looking to take advantage of that blended return. But I do see it as a way, and a pretty obvious way, to provide housing for people with disabilities. I think some people are concerned about creating enclaves of where everyone's got a disability and they're living together, and you've got kind of a group home type model, and I acknowledge that. But at the end of the day, it's about creating supply, and maybe it's not the perfect option, but it's an option. I see a lot of people shaking their heads. So. Probably the last thing I'd mention, there's been a lot of discussion lately about build to rent in Australia, and it kind of ties in with this housing affordability issue. If you just go to the next slide. Build to rent hasn't really worked, mainly for a whole bunch of tax reasons. So there's been a lot of work going in New South Wales and Victoria to try to facilitate an arrangement whereby those projects are actually financially viable. Usually, residential returns will give you a yield of about 3 to 4%, and that's really not adequate. It's slightly above inflation. Once you deal with some of these issues, land tax and the treatment of managed investment trusts, then those returns can get up to the kind of 8 or 9%. Again, talking about that blended model, there might be an opportunity to incorporate SDA into those projects, and whereby those institutional investors are still getting the benefit of those tax exemptions that I just talked about. So that's a pretty quick summary of the things, but I wanted to talk about just the broad spectrum of project structures that we're seeing. And it's not a one-size-fits-all approach to these projects. So you really kind of have to look at, take into account who the funders are and who the residents are going to be to make some of these projects work. Thank you.
Adina Surston from the Property Council, and I guess and Neil does talk to me all the time. We quite like each other. But I just want to go back, Tony, to the build-to-rent model, and I think, what we're hearing here is there has to be a financially viable way to make these stack up, and I think build-to-rent is a really exciting way, and certainly Property Council's been talking to governments right across the country about getting the tax settings right, which allow those developments to be viable. And for those people who don't know, build-to-rent is really very simply, if you took a building of 140 residential units, they would be held by one developer or managed investment trust and then rented long-term secure rental. So it really changes up the landlord-tenant relationship. And in the UK, 125,000 units are currently being built or in operation, and 20% of those are actually community housing. And so really getting the balance right. So I think there's great potential to do it here in Canberra. I know there's there's billions of dollars sitting offshore waiting to get into Australian market. And I think, and there are some private developers in Canberra who are actually looking to do it as well, but it is about getting the tax settings right. So I'm interested, Tony, are you getting positive feedback around what's required, or do you think there's still a lot more work to do to get to there?
I think there's still a lot more work to do. I mean, I think the Property Council of Australia has proposed some kind of COAG working group, or that's been discussed, because there needs to be agreement between, obviously, state, federal and local government to try to get this to work, because all of those entities have a part to play to actually get the settings right. So I know that there's been a bit of movement in New South Wales and Victoria, but I don't think it's not quite there yet. But it's interesting talking to people who have been involved in the build-to-rent projects in the US and the UK, because touching on what you said, they're there for the long term, the renters. And there's a greater sense of, apparently, of community and so on in those places. And I think touching on some of the issues that were raised before quite rightly about how people feel and what they need to be comfortable and kind of reach their potential, I guess. It's a definite option. But I think it's still moving pretty slowly. But there is a lot of momentum. I don't know if you agree, but I think there was a build-to-rent conference up in Brisbane last week. And so I think a lot of the advocacy groups are starting to move in that direction.
Do you see anything about the ACT that would enable it to be swifter or more easy to do here? Are there any particular systemic barriers in terms of getting some of these models on?
In the build-to-rent in the ACT versus elsewhere? No, I don't. I think the issues are, I mean, each of the states have their own different planning schemes and so on, but they're all kind of similar problems across all of the states, I think. So that the issues that need to be dealt with here are similar to the issues that would have to be dealt with in the other states as well.
I might just, I think one of the issues is around the definition and actually really understanding what build to rent is, and that's what we've heard from people who've come out from the UK, for example, who are actually delivering this product. And I know in their ACT housing strategy there has been a commitment to release land for a build to rent model to come forward. But I think you need to be very clear that it needs to be financially viable as an asset class. That you have to get it to stack up. Yes, you can have 20% community housing in there, but this is not a community housing model, but it's a way of delivering community housing, with a diverse range of community members living all together. And I think that's a great opportunity really for the disability housing people here.
Yeah, I mean, it's interesting because a lot of those tax issues that apply to build to rent, not-for-profits get a lot of those exemptions anyway. When you think about land tax and stamp duty, GST, so there's almost, I wonder, to the extent they have the capital or can raise the capital for them to do something that's akin to build to rent, that's in line with their purpose and mission. One thing I would say, I've been running an AAT appeal. I'm sorry, that was in relation to SDA, and I just got notice about 10 minutes ago that we'd settled, and they basically agreed to provide SDA. So I don't know whether that's an internal policy issue, at the NDIA about trying to facilitate people with SDA in their plans. But I'd say to date, that's been one of the biggest issues, is actually having enough people with SDA in their plan.